Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, Bill interviews Charles Henry Monchau, Chief Investment Officer at a Swiss private bank, renowned for its innovative approach in the banking sector. Charles shares his extensive international experience and insights into the evolution of private banking, emphasizing the integration of digital assets and pioneering private equity investments. The discussion explores the importance of staying updated with market developments and the impact of technological advancements like blockchain and AI on the financial industry. It also touches on challenges and opportunities that the current economic environment presents, highlighting the strategic approach to asset diversification and investment in emerging technologies. Listen in.
Charles Henry Monchau, welcome to Educational Alpha.
Hello, Bill. Thank you so much for the invite.
My pleasure. We hatched this plan in a very windy day in Geneva just a couple of days ago. Hopefully spring has sprung there. We're still waiting for it to happen in Boston. And one of the things I really love about my job, I travel around the world and I meet a lot of very interesting folks, and you're in that cohort, no doubt. But then I come to find out you're a Kaya member and almost a pioneer, having joined us just a couple of short years out of the box. And you've been very active of late. But before we get into some of the challenges and opportunities in the market, which is where I want to spend the bulk of my time, maybe you could just give the audience a little bit of your background and experience. I know you've been a global citizen, having spent a lot of time in the Middle East and elsewhere before you got yourself stationed permanently in Geneva.
I was born in Greece, grew up in Africa, and I'm Swiss and French, and indeed spent some time in the Middle East, also in the Bahamas. I've seen a few countries, but always with the same passion for financial markets. This has been my main driver. So I've been in the business for almost 30 years now. I think what is always amazing with finance, macro markets is that there are always some new things coming. And you also need always to keep updated with new asset classes, new techniques. And by the way, this is why, I took and passed the Kaya back in 2006. So it was indeed a very long time ago. I really encourage everyone to always keep updated with new developments in markets. My current role is Chief Investment Officer of SYZ, which is a Swiss private bank boutique. And in this role, I'm overseeing the asset allocation committee and both discretionary and advisory services that we give to our private clients.
So a little bit on the asset management and private banking world in Switzerland, and more specifically Geneva. I have worked in the space myself in the US for the vast majority of my career, but what that means in any part of the world could be different. It's interesting when I go and look at how the SYZ Group describes himself. They describe themselves as an alternative to the Swiss private banks. So what makes SYZ different and special and unique?
There is probably one characteristic of Swiss private banking, which is well known, is the fact that it's very strongly rooted into the financial world as being very safe, with very strong foundations. There are everything which is surrounding the fact that Switzerland is a neutral and very stable country. What sometimes lacks with, let's say, the Swiss private banking industry is the fact that it's maybe too conventional. And this is where we try to, let's say, differentiate ourselves. Eric SYZ, by the way, was one of the CEO and founder, came back from the US in the mid-90s with the will to develop hedge funds offering in Switzerland. And this is how, by the way, he was able to put SYZ Bank on the map of the Swiss private banking industry. And after hedge funds, the firm has been also a pioneer into private equity, direct investing. And very recently, we became one of the very few Swiss private banks to offer digital assets, custody and trading services to our clients. And we also launched a fund of crypto hedge funds. So this is where, we try to differentiate ourselves. So we are the pure tradition of Swiss private banking industry, but we try to be ahead of the curve when it comes to innovation and new type of products and services.
And your client base, broadly speaking, is this ultra high net worth and single family offices? Is that primarily where you travel?
Yeah, that's correct. Both in Switzerland, neighboring Europe, but also emerging markets. This is where, we do see the largest and growing demand, more and more millionaires in the emerging world. And one of their priorities to keep their assets safe, and Swiss private banking has a strong value proposal on that side. They want their assets being safe, but also want to see innovative strategies again. And this is where we try to differentiate ourselves.
I want to spend, as I said, the bulk of our time talking about opportunities and risks in the marketplace, and not given your experience only and where you're currently at. Those are very important attributes to have that discussion. But somehow, some way, you've been able to build quite a following on social media. You have, I think, 160 some odd thousand followers on LinkedIn as an example. Maybe talk a little bit about how you got there. And then I also want to get your view as to whether or not that's an asset or a responsibility. And maybe it's both, because if people are listening to you, you have to be balanced and you can have your opinions, but they have to be wrapped in maybe news they could use, so to speak, as well. So your pathway toward 161, I've got about 140,000 more followers until I catch up with you, and maybe time is not on my side.
I've been using LinkedIn for past few years, obviously first and foremost as a professional tool, as a way to improve the branding of the employers I had. And this is also what I've been doing with Banksys. But not only that, the way I've been using it is to share knowledge and experience, in the sense that it's a win-win, because on one hand, it is useful for those who are following me to understand what is happening on the market side, what is happening on the macro side, what is CDS, why it's key to be diversified when it comes to asset allocation. So this is, I think, useful for those who are following me, but it's also very useful for me and for my firm when you want to learn about something. If you listen to it, if you read something, you learn, okay. But the best way to learn to a greater extent is to explain what you understood. When you try to explain something, this is how you develop mastery on different topics. And I think on that side, it has been extremely rewarding to always share knowledge, because not only it's, again, useful for those who are reading it or who are following me, but it's also very useful for me and my team, because this is how we get stronger, being, let's say, proficient enough in what we do to be able to explain it in simple ways to a broader audience. And I think on that side, it's, again, a win-win, and I love win-win. I think in life, win-win is the best thing you can find.
It is. And I think channeling human behavior into that corridor is sometimes difficult. And I think we have in many parts of the world markets that are priced for perfection, but we have a lot of storm clouds, not the least of which is inflation, recession. Certainly here in the US, a third of our treasury debt is rolling over in the next 12 months. And that's a big number, $10 trillion. And to think that the Fed can be setting rate policy when you need more buyers for this debt, and they're going to have an opinion as to what they want to be compensated for as well. It leads to a lot of challenges. So expectation is not risk management. I think oftentimes people think that it is. And so maybe some of the things that top your worry list, and it can go from geopolitical to inflation or anything else in between, and our expectations now misaligned with underlying economic fundamentals?
I tend to look at things in the optimistic way. First and foremost, when it comes to investing, the best is to be invested throughout your whole life and as long as possible, because this is how you really benefit from the compound interest. So you need to invest. For all those who are listening to us, if you open a newspaper, headlines are full of negativity. It's full of very scary news. But if you look at the S&P 500, or let's say an index of hedge funds or index of private equity, over the long run, the natural trends of all of those asset classes is to go up. That's, let's say, a representation of human being. Human being, although it's making many mistakes, at the end of the day, there are improvements in the long run. And the same happens with financial markets. So you need to take the long-term view and you need to be invested. If you look at the current context, the decade where we're currently going through, actually, never ever we have seen so many innovation coming. It's full of very exciting news and technologies, advancements, you name them. So blockchain, AI, genomics, electric vehicles, batteries. Have you ever seen so many innovation coming at the same time? So that's one. I think that's very, very encouraging. Two, we live in a world of higher inflation than before, but also higher nominal growth. Because people tend to always look at the, let's say, dark side of inflation. But there are also some good things in the sense that it helps the top line of companies. It probably forces consumers to spend, and it also forces investors to invest into risk assets. I'm very aware of all of the downside of too much debt. Higher interest rates for longer also create risk. Obviously, there will be some accidents down the line. We have seen last year some of the banks in the US going through trouble. So we'll see troubles. There will always be some troubles down the line. But on the other hand, when you put together the fact that nominal growth is very strong, that also we are seeing many innovations coming, probably helping productivity and thus inflation, in the coming years to come back to a reasonable level, I think that there is also some reasons to be optimist and also to allocate money into risk assets instead of sitting in cash and waiting for the end of the world.
Hard to take the other side of any of those observations, and maybe less issue or concern for a single family office as an example, but certainly back in the United States and around the world, this concept of democratization is alive and well. And if I'm more of an average investor, your advice still absolutely holds water. You stay fully invested, and these bear markets can bite very hard, but they usually come back and the trend is always pointing up. But if I think about accessing the public markets, the spot for innovation used to be in the micro and the small cap space. For the most part, that doesn't exist anymore because that's now moved into the private markets. And early stage VC and maybe even some growth companies in the private side, that's where a lot of this very interesting opportunities are happening, but the investor is choked off from that. And then the banks, certainly again in the US, but I think somewhat true around the world, because of Dodd-Frank, they're not lending anymore. And a lot of these big GPs are now coming for investment grade as well. And if you look at public versus private lending, all things being equal, it's a better asset liability match because I don't think we have to worry about Apollo having a run on the bank, but Silicon Valley, maybe something different as well. So I think your advice is spot on, but for the average investor on the street, how do they access this innovation? And the answer might be democratization, but it's more complicated than that. Or maybe this is not something you worry about all that much because it's not the space you play in.
You made some very interesting points. The first one is that there is indeed a fact that the AI bubble is very different than the dot-com bubble. For those who were in Wall Street or in finance during the dot-com bubbles, it was indeed a flush of a lot of small and mid-cap companies coming to capital markets without a strong business model, but with a lot of promises when it comes to their future. And this has created a huge bubble that everyone were able to play, but so many people got burnt. These days, it's indeed in the hands of just a few huge firms. They are full of cash. They have the ability to attract the best talents. They have the cash to invest into huge amount of R&D. And on top of that, there are so much cash that are also buying back their shares, which means that there are less and less shares available to play AI theme. And you're right, then the only way to then invest for the future of AI or the future of innovation is at the time being to go to allocate into the private space, which is indeed not available to the general public. Now, there are two good news. If you look at the regulation in the US, there were first these acts enabling crowdfunding. I think crowdfunding has been something which has been quite spectacular over the last few years in the US. And now what lies ahead is tokenization. On that front, let me share with you a very simple story. You're probably aware of either the security tokens or the utility tokens. So basically, you can buy these tokens on an app with just a few $100s. And these tokens basically enable you to invest into very early stage companies. We organized a small event in the middle of Switzerland. We were talking to our clients about tokenization and the future of digital assets. We invited one entrepreneur who presented his business model, his firm, which is about making sure that by putting a digital certificate on a watch, that if you sell your watch as secondhand, the buyer will be sure that that's a true watch, that's not a fake. And there were, clients in the room, many of them average age 60, 70 years old, so not, let's say, necessarily the type of clients interested by digital assets. But when they listened to this guy, entrepreneur, the same neighborhoods than themselves, they immediately understood, let's say, the value added. And they say, by the way, how can we invest into your firm? I say, it's very simple. There is a token which is available, and you can just put a few $100s and a few $1,000s. By the way, Bill Ackman is invested in my company, so you can invest alongside Bill Ackman. So what a great example of what digital assets will bring to the table. Bill, this is exactly what you have been doing with Akaya, is trying to explain what are alternative investments. Now, these alternative investments, which are just available for institutional investors, they will become available for not just high net worth individuals, but also Main Street. And here, digital assets will make the link between, let's say, non-public markets or private markets and the willingness by investors to invest into the true economy. Because for them, this is the true economy. They invest to a firm. They invest to an entrepreneur. They don't invest into something which is, let's say, fake or super speculative, like maybe Bitcoin or, let's say, Solana or whatever tokens. They invest into digital assets, which is ownership into a real life company that they truly understand. I think that this is very promising. This means that we are moving from stock exchange to asset exchanges, and the upside is just huge. So I'm really looking forward for this next step of financial markets.
I'd be curious, Charles, to get your thoughts on this. And I think it's instructive if you look at the internet before we get to Web3 and tokenization, et cetera. And if you look at Netscape in the late 1990s, that had 90% of the browser market. And it wasn't until maybe 2004, 2006 that Google even started to get a meaningful share. Now their business model is being perhaps threatened by generative AI. And I think sometimes we have a tendency to dismiss the provider of the service as well as the service itself, where the first mover could have a disadvantage because the next one comes along and takes what works well, rinses out what works less well. And now Netscape is barely a footnote to the history, but the search engine is alive and well. And if I bring that back to what you just said, and again, maybe through a US lens, but probably globally, a lot of these security tokens were affinity tokens. And we talk about a Beeple artwork through an NFT that's valuing something through Sotheby's at, $69 million. And this is what grabs the headlines. And when the whole thing just blows up because it never should have had value in the first place, people have a tendency to write off the whole concept. But I think if the listener thinks about a security token as being a modern day security certificate, it's today's stock certificate. It's representing ownership in a real asset that might be off chain that has cash flow attached to it. And I can transfer that in an immutable way. That is pretty damn powerful. And yet Beeple grabs the headlines.
Your example is spot on. You could be positive on internet initially and then totally wrong with Netscape. Or I did the same mistake I was a very early believer in smartphone, but I thought that Palm was going to be and probably most of the listeners don't know anything about Palm. And then, the iPhone took the lead on this. So it's key to understand when there is indeed a new wave, an innovation coming, that there is a paradigm change happening. But be very careful with the way you play it, because you can be right on the thesis and totally wrong on the vehicle. And I think with cryptos, with digital assets, a bit the same story. So there are many people who are burning themselves by going into the wrong investments. And then they start to, let's say, become very negative about the whole landscape. I think the blockchain, digital assets are very exciting, but there will be many, many casualties. And if you believe in Darwinism, Darwinism will be in full speed. Only the fittest will survive, and there will be many, many casualties. But that's the beauty of our job, and is to try to first understand the big picture and then identify, who will be the winners and losers.
I agree. I do want to spend a little bit of time on Bitcoin, maybe as a subset of digital assets. And you wrote a paper recently that I saw on your website, Hyper Bitcoinization, and we could talk about exactly what that means. But maybe just to throw a fat pitch toward you on this is, if I think about the US dollar as a medium for exchange, if the average person was sitting on their couch and trading the US dollar 24/7, I shudder to think what the volatility of that currency would look like. Yet we have a tendency to view it as a medium exchange. I can go and buy a cup of Starbucks coffee with it, but I'm not trading it as an asset class. So again, maybe this is the first move of the camel's nose coming in the tent that I don't know where Bitcoin is going to end up, and you would have more informed views, Charles. But the fact that it's this nondescript and that security, commodity, currency, whatever it is, but it's actively traded. I flip on CNBC and I see where it is on every single day, and expectations is going to 500,000. I think we've defined it for what it's not or what it should be versus maybe what it can be when the dust settles. So what is your take on Bitcoin specifically? And I didn't get a chance to read the full paper. And maybe you can tell me at the end if I can walk down to my local Starbucks, and if I owned any, if I could buy a cup of coffee with it.
The way we see it is more like a digital gold. And by the way, if you look at the history of gold is not that volatile these days, but it used to be much more volatile. If, again, you look at history, you project it, in the very, very long run, maybe Bitcoin will be much more valuable and less volatile than today. But what you need to take as a investment decision today, if you consider Bitcoin as investment, is that, do you prefer a high volatility assets, which is appreciating, or low volatility asset, which is depreciating? And I'm going to give you a very simple example. We in Switzerland have the advantage or disadvantage, it depends, to have a very strong currency. So over the last 50 years, Swiss franc has appreciated in average by 3% every annum against the dollar. 3%, that's a lot, on a component basis. Against the pounds, it has been appreciating by 5% on average per annum. So just think about it over 50 years. You don't feel the volatility. You don't feel it. But on the other hand, over the long run, you see a huge depreciation happening. That's a bit the question mark that you need to, if you believe in Bitcoin, are able today to live with that kind of volatility if I believe that over the long run, it will appreciate against dollar or not. And it's still a very open question. Obviously, no one has, let's say, precise answer. But just to finish on this, the reason why also we label it digital gold is that we indeed live at a time of, you started to talk about the very high debt level in the US. There is a big loss of purchasing power over time of fiat currency. And one way to protect investors against money debasements is indeed gold and potentially digital gold. And this is why we are looking at it. Again, we don't recommend a big allocation to it because it's highly volatile, highly risky. But Bitcoin could be one of the answers to the current money debasement we're currently going through.
A couple things on that. One, maybe as a practical matter, back through the US. So the SEC just recently approved spot Bitcoin ETFs. And I don't know how I feel about that. And I'll tell you why, and I'm curious to get your views as well. I can't think of any asset that I would consider buying that would be wrapped in an ETF that had no diversification at all, the only asset inside of that ETF. So I think that and maybe it's the best we have right now, but if I went to a big shop like Fidelity and they were offering me a spot Bitcoin ETF, does that interest me versus going to maybe a CTA that's got exposure into a lot of different assets, including the futures market with Bitcoin. Now I got diversification, as you say, I've got a foot in the game. And I think that the average investor, if they're focusing on their expectations, and their expectations is, well, I don't know what Bitcoin's trading today, but say 70-ish thousand, and they think that if Kathy Wood says it's going to $1 million, it's going to $1 million, and I'm going to put 15% of my portfolio in there. Well, you better be up for a lot of volatility between here and then. If it's the only game in town, I just am curious to get your views that do we have a tendency to fall in love with the Bitcoin story and not get the diversification play and maybe over allocate to it?
It's a very fair point, Bill, but you forget one extremely successful ETF, which has just one underlying, which is a GLD, the gold ETF, which, by the way, really helped many savers, investors to have an allocation to golds without directly owning physical gold. And this probably has inspired the SEC to allow this to happen. The other inspiration was the fact that there was a huge trust, so the grayscale, Bitcoin trust with heavy fees, and also with the tendency to trade either a premium or a discount to the NAV. It also probably, let's say, encouraged them to look at it. And I think that Larry Fink back in 2017 was talking about Bitcoin being an index of money laundering. And then he flipped around and he said that maybe there are some very interesting properties around Bitcoin. And now, by the way, if you follow Larry, he is extremely vocal about tokenization. And it's probably, I think, one topic BlackRock is inviting us to consider and that we will agree on is that indeed that could be the next step.
It is the plumbing in the basement, which is the distributed ledger. And I think that is maybe oftentimes not talked about enough, but that is the lifeline as to what makes this so interesting and so powerful. And I think a lot of things we've talked about, Charles, including access to early stage VC, the ability to utilize some form of distributed ledger might be the way of getting the average investor into that space. And maybe there could be some price discovery and somebody's got to play sort of referee, so it'd have to be permission. But I think it is early stages, both with the blockchain and the assets that move across it. But I think if you just can understand the simple concept of distributed ledger and what's running across that can be off chain, it can be a building I can physically point to and touch, or a piece of artwork, or an EBITDA off a specific company.
I really love these two examples because real estate, this is where we are seeing the biggest push currently for the first tokens, because that talks for everyone. Getting a piece of building and getting the stream of cash flows attached to it on a digital way. It's also great for banks because that means that the assets stay with the bank, because digital assets are obviously part of the financial statements. And you mentioned piece of art. So Banksy's is almost like a small museum. So we have piece of art everywhere. And what the SYZ family did is that they tokenized one of the art piece to enable all of the employees to get one token on each on these art piece. And it was very, very well received by all employees because that also creates a sense of ownership, of belonging to the SYZ family and the story around them. So there are so many things that can be done. And again, it's going to be fascinating. I think it's really create this link with also alternative investments, which is likely to become mainstream in the years to come.
Very interesting. So before we leave this, just one last thing on this topic of digital assets. What is Switzerland thinking about around a central bank digital currency? I know a lot of sovereigns are giving it some thought. I think the US is probably behind the curve a little bit. Is Switzerland moving in this direction? And if they are, what are the pluses and minuses of it?
Switzerland has been extremely supportive of everything around digital assets. We have a DLT law, so a digital ledger technology law, which has been, let's say, in place for some time, which is enabling this access to tokens and is going to happen in the years to come. But let me give you a digital Swiss franc. There are already some live examples. In the south of Switzerland, if you have any chance to go there, you will love it. Lugano, so which is just at the border of the Italian border. So the city already is enabling citizens to pay their taxes and fines in digital currency, either Bitcoin or Tether, or the equivalence of, let's say, a stable coin to Swiss franc. They also created an ecosystem because it's so close to the Italian border. So there is a tendency of Lugano inhabitants to cross the border to buy goods and services cheaper on the other side of the border. So what they did is they say, okay, if you live in Lugano and you spend with the Lugano tokens in Lugano, you will get a discount. And this keeps people spending in Lugano. So you can see the kind of ecosystem you can create thanks to the use of tokens, including these stable coins or CDBC, whatever you call them. They are pegged to the Swiss franc. And all of these creates a belonging to Lugano. You can spend with these tokens, you can pay your taxes, you can pay your fines. There are so many things that you can pay with these stable coins. And that makes also, let's say, the whole economy much smoother and leaner. So there are a lot of win-wins again on this.
And it takes some of the cat and mouse game at the borders off the table a little bit too. So I think maybe a plus for the border agents. Just in the remaining minutes, I think this is a good place to wrap up, Charles. And I may have alluded to it at the beginning of this conversation, but one of the pieces I saw up on your website that you wrote recently, I'd love the title, Keep Calm and Stay Invested. And I think if we could just hammer that into the skulls of all investors, it's great long-term advice. And you may cover this in the piece, but I think part and parcel of that is staying pretty well diversified as well. And then there should be some concept of coming back to maybe a level of risk or a model portfolio, because risk is constantly being repriced and you may have to do some reset back to that risk. So maybe some of the themes you're thinking about, I did write about there, but what it means vis-a-vis diversification and resetting back to a risk number you're comfortable with.
The long-term view or principle remains the same, so stay invested. But what has changed recently is the correlation between equities and bonds. Last decade, negative correlation between equities and bonds. That was very comfortable because that means that when equities were going down, US treasuries, long duration, were going up. So that creates, let's say, lower risk within portfolios. Now, this is broken. So we have this positive correlation, which means that if you want to keep your return to ratio equal to the one that we had last decade, you need to increase your allocation to equities because there is higher risk. So if you want to keep return to risk ratio equivalent, you need to have higher allocation to equities. That's point number one. Point number two, because bonds are less diversifying than before, you need to find other ways. So it can be cash. It can be the use of maybe investment grade bonds instead of investment grade corporate bonds for US treasuries. It can be gold. But for those who can also afford to have, let's say, lower average liquidity within the portfolio, you can then move into alternative assets. Again, the overall principle, keep calm and stay invested, remains, but you still need to tweak a little bit the kind of assets you allocate because this is a new paradigm. And if you believe that inflation might stay, let's say, higher for longer, you need to find, let's say, new ways to diversify your portfolios.
A great way to leave it. And I think ultimately, as you just alluded to, Charles, this requires professionalism, professional advice, certainly self-serving with credentials like Kaya and CFA. And you've been a big consumer of professional education your entire career and continue to do that. So I want to thank you for having taken the time to share some of that with our listeners today. Thank you for your membership. And I really did enjoy the conversation a lot.
Thank you so much, Bill. It was a true pleasure. Thank you so much.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the Kaya Association and subscribe to the show at kaya.org. That's CAIA.org. See you next time.